Hello, everyone. My name is Martin Karaman. I'm the partner in charge of our tax credits incentives advisory group. Welcome today. I'm just putting up our slides in a second. We'll have them up. And I wanted to welcome also Deb Walker who's the director at the firm in charge of compensation and benefits. We're going to have a really good conversation with you today, I believe, on the employee retention credit. We do these once a month, really, because the clock is ticking toward the statute closing on the 2020 ERCs. But there's also so many developments, both from we'll call it industry or taxpayer perspective as we see what's going on, but also from an IRS perspective going forward. So we're going to cover a lot of the developments that have happened over the last really 6 months, which we almost add a different one to it every time because there's normally something else to talk about. At the same time, we're going to do a bit of a focus today on acquisitions and dispositions and some of the issues that we see in that context. So with that said, Deb, you want to take a minute to introduce yourself and say hello?
Yes. Hi, I'm Deb Walker. I do the technical work for the ERC team, and I've spent most of my career working on compensation and benefits and employment taxes.
Very good. All right. So as mentioned, today we're going to cover just the background on the employee retention credit, how the benefit works. We'll talk about some current updates. One being very new, the IRS program to withdraw claims, which is a follow-up to the IRS moratorium that was that moratorium on the processing of claims from September 14th, 23 through probably the end of the year. And then we'll talk a bit about our experience in IRS exams and audits, and then talk a bit about acquisitions and dispositions too. But we'll make this conversational. I'll try to throw some questions at Deb as things come up. She'll throw some back at me, and we'll talk this through. Excellent. So our first polling question. It's always the same one every time. So how have you or your company ever applied for the ERC? Yes, no, not sure if eligible, or holding off because of the IRS moratorium. We'll give you a minute to fill that out. But we will say that one of the things that's published on our website, one of the articles we put out on the IRS moratorium, is that if you have a valid claim and you really do qualify for the employee retention credit, don't hold off to submit your filing for it. The IRS will still accept the application. They'll still accept the 941X, but they won't process it. But due to a prior backlog and potentially more of a backlog coming during this moratorium period, it is smarter to get it in sooner rather than later, especially considering that the statute on the 2020, which is one of the 4 ERCs, takes the period March 13th, 2020 through December 31st, 2020, that closes April 15th, 2024. And then the 2021 ERCs, all 3 of them, the statute for those closes April 15th, 2025. No change in those statutes for now. Hopefully, certainly not. Hopefully that doesn't happen as well. All right, great. It looks like not sure if eligible, 30%. And holding off because of the moratorium. If in that 30 you have any questions or want to reach out to us, please feel free. For questions in the chat, let us know. Thank you. All right. See if I can get these slides to go. Great. All right. I'm technologically enabled. With that said, let's talk a bit about just the basics of the employee retention credit. There are 4 credits. It's a misnomer that it's just the ERC. There are 4 separate employee retention credits. Each has a separate qualification criteria. The maximum credit for the 2020 credit, which was the first credit put into the law, is $5,000 per employee. Essentially, 50% of the first $10,000 paid to any basic qualified wages paid to your employees. The next 3 credits are for the first 3 quarters of 2021, and that's 70% of the first $10,000 of wages plus healthcare, employee-borne healthcare costs can go into the employee retention credit. So that is $21,000 per employee. So the maximum is $26,000 per employee, which I'm sure is a number you've seen thrown around quite a bit. But that is only if you were to qualify for all 4 employee retention credits and were able to maximize it. One thing we may not cover too much in this is that if you received PPP money, you cannot utilize the wages that are funded by PPP in your employee retention credit calc. Nevertheless, if there is the ability to properly allocate PPP funding in a way that doesn't overlap with a lot of the ERC funding. So it doesn't always bring down the credit calculation, or maybe not significantly, but there is work to be done to make sure you can maximize that going forward. So there we go. We'll talk a bit about that more going forward. Okay, so there are two ways to qualify for the employee retention credit. One is what we call the government order or the government mandate test. And this I found for legitimate claims was much more common in 2020 than 21 due to the fact that there were so many government orders out there. Essentially what we're looking for is a COVID-19, specific COVID-19 order issued by a government, for the most part, that limits commerce, travel, or group meetings to some extent, and to the extent that that limitation has an impact on a more than nominal portion of the business, causing what's known as a partial shutdown. There's some analysis to do from a facts perspective to understand how these government orders affected a company, and you only are qualified for the duration of the particular government order. What we've seen a lot back in 2020, some businesses were essential businesses. And so the government orders did not affect them. It didn't shut down the business per se, but oftentimes there's still some other group meeting limitations that may still apply to essential businesses, which you can look at, like how many people could be in a room, which caused some of the work from home stuff, but just working from home is not enough. That time working from home, or the work from home, had to still cause basically a partial shutdown on the business. The other way is, and I see this more commonly in the 2021 credits, is what's known as the gross receipts test, a significant decline of gross receipts to the extent a company experienced on a quarterly basis, say, for example, in Q1 2020 compared to Q1 19, a more than 50% decline in gross receipts. And that, for most part, includes things like sales, dividends, interest, rents, royalties, other income as well. It's a full amount of gross receipts coming in. To the extent that there was a significant decline, that decline is almost deemed to be due to government orders out there on the customer base of the taxpayer looking to qualify. They can look at that test independently for each of the quarters of 2020. But again, it's just one credit in 2020 that spans all 4 quarters, or a portion of all 4 quarters. And so the maximum you can still get is only $5,000. Because this more than 50% decline in a quarter is somewhat, I won't say rare, but not as common as companies who had just couldn't use the government order test in 2020, showing that the government orders were limiting the business, that 50% is quite onerous to hit. In 2021, however, for those 3 quarters, the test changed to just a more than 20% decline. So many companies experience a 20% decline in their gross receipts in each of the first 3 quarters of 21 compared to the first 3 quarters of 19, respectively. And with that said, that's why I see more companies qualifying under the gross receipts test in 2021 than I did in 20. Government orders, some of them started to get lifted in 21, especially as you progress through the year. The thing, though, that we have seen is, and the IRS came up with a position in the notice that indicated that to the extent like an essential business or a business had a supplier, and that supplier had a government order on it, and that government order caused a kink in the supply chain that essentially caused the business itself to have a partial shutdown, you can sort of, through a transitive property, utilize the government order on the supplier to qualify the business itself. But there's quite a bit to look at with that. And the IRS come up with some rules around supply chain disruptions as well, clarifying that you have to specifically identify the order. You have to specifically identify how that supply chain disruption caused a partial shutdown of the business. And also you have to show that you didn't have excess supply on hand when that happened, and that you couldn't have gotten a supply from somewhere else. So it's not just as easy as saying there's a supply chain disruption generally in the economy, I qualify. That's the biggest no-no, I would say, from an IRS perspective. And then, Deb, maybe you want to talk a little bit about how some of the taxpayers, it was expanded a bit on the public colleges, some of the other organizations that were allowed for the 2021 credit, if you don't mind.
Well, yes, there was an expansion. I think there was a feeling that public colleges and universities and healthcare organizations should be entitled to this credit. So we do see an expansion there. Often those entities have more than 500 full-time employees, so it's difficult to actually realize a credit in those entities. We'll get to the 500 person rule, but generally, if you have more than 500 full-time employees in 2019, then you can only take a credit for wages you pay to somebody who's not working. And in 2021, there wasn't much payment to people for not working. We did see that a lot in 2020, where we had bus drivers or cafeteria workers, and typically lower paid, where the organizations continued to pay those people for not rendering services. But I also want to talk about the controlled group test, the last bullet under the gross receipts. You have to make sure that you determine your gross receipts on a controlled group basis, which means you have to figure out who is in your controlled group. So typically for income tax purposes, we have parent and subsidiaries and brother-sister organizations. All of those rules apply, but there are also some rules for management organizations and affiliated service group rules, which are retirement plan rules. But the first thing you do is figure out who is your controlled group. And then you figure out from there, what were their gross receipts? You don't take into account any gross receipts that are intercompany gross receipts. Marty?
Yeah, no, we're good. Sorry, we'll move on to the next one. Okay, so let's talk a bit about the IRS program to withdraw claims. And Deb, I'm going to rely on you a bit to talk about some of this here right now. But we were made aware, and we're doing this in reverse order somewhat. There was a moratorium, as we talked about. The IRS has been experiencing a backlog of claims, partially due to the popularity of the program, partially due to a lot of fraud in the system. And so there's what the IRS will refer to as a number of ERC mills who generally charge contingent fees, who are, I don't know, overqualifying companies, shall we say, or relying on their testimony just to based on potentially false information in terms of how easy it is to qualify. And so the IRS is dealing with a number of claims, and there's quite a backlog. So while they, we'll call it, took a breath from this over the last 3 months of the year, they also indicated that they would come up with a plan for companies who may have filed for the employee retention credit to withdraw that claim with no penalty associated with it. But we'll go through these rules a little bit and some of the developments. But Deb, feel free to sort of step in and talk a bit about what you've seen or what you've heard about this.
So on the withdrawal claims, I haven't really heard that much about people with using this withdrawal process. I think people are still in the state of determining whether in fact they should withdraw their claim. And so we've helped a number of people look at the claims they've already filed and see whether we think that in fact they would qualify and how they can better document in case the IRS comes in and asks if they do qualify. The biggest mistake, the IRS says the biggest mistake they find when people are trying to withdraw the claims is they forget to sign the withdrawal document. So let's explain a little bit about how this all works. You have to withdraw the entire amount of your ERC claim, and your ERC claim has to have been filed on an amended tax return. And you have to have either not had the claim paid yet, or if you had the claim paid, you didn't cash or deposit the refund check. So if you, what you need to do if you want to withdraw your claim is you take the form that you used filing the claim and you write withdrawal in red on the left-hand margin. And then you sign on the right-hand margin your name and date and title. So you're signing, and then you fax the form in to the IRS, or you can mail it in. Of course, if you have a check that you need to return, you write void on the check, and then you return that, and there's an address that you send it to.
Yeah, exactly. And there's essentially, it's three situations, right? It's if you haven't gotten the refund and haven't been notified that it's under exam. 2, if you haven't gotten the refund and notified that it is under exam. Or 3, if you got the refund but haven't cashed the thing yet. Don't cash it, I guess, would be the first thing, because once you do cash that check, you're out of this program.
Although there is going to be another program.
Yeah.
The second program is a settlement program. And that's for people who have actually gotten the refunds and cashed the checks. And we don't know what that settlement program is going to involve. But what I'm advising clients is sometimes we will, as an accounting firm, we have to review financial statements. And in reviewing financial statements, we often have to sign off on the ERC claim. And sometimes we determine that the client did not qualify for the ERC, even though they have already gotten the check and deposited and whatever. And to those people, I say, well, yes, you do have to amend your returns. So you're not going to and return the money that you got. But I also suggest that they wait until we see what the settlement program looks like, because there are rumors that the settlement program may not require taxpayers to pay back all of the money they got from the government. It may require them only to pay back the money they got from the government minus what was paid to the person to complete the ERC work. I would be surprised if the government went that way. I think they're probably arguing about it a lot. They've told us they're going to give us this settlement program before the end of the year. I would expect it before the end of the month. But it hasn't come out yet, so we don't know what the rules are, which is why I advise to wait on filing amended returns if you've already cashed the check. And of course, if the IRS comes in and audits you, you have to tell them right away, we don't think we qualify for these quarters and why. I mean, the goal in any IRS audit is to be straightforward and help the auditor do his job so he can get in and get out and everybody can get on with their lives.
There was testimony in front of the House Ways and Means Committee by 4 individuals, 2 of whom were practitioners. One was the head of a PEO and the other was the head of a nonprofit organization. One of the things they pointed out that was going to be onerous for companies who learned that they ultimately didn't qualify and maybe got suckered in by an ERC mill to do the ERC program was that they were out all that money they paid to the ERC mill. And so that was what began that discussion about not having the amount paid to the provider to potentially not be part of the amount you have to pay back. We'll see what happens. That's what began that discussion, as I recall it, back in June or July.
Mm-hmm.
So this is just some of the stuff, some of the background here about what you do in each of the contexts of whether you got the money, whether you're under exam, etc. All this stuff is background and will be available. But Deb just covered most of this, what's happening here. We've got the addresses and where you send all this stuff. Okay, IRS moratorium. I can talk a little bit about this, and Deb, just you can be my color person here to talk a bit if there's anything else you want to come in. But this began that. This was a shock to the system, I would say, but also potentially maybe not unexpected in the context of an incentive, a subsidy, shall we say, a stimulus program that you see on the TV every night or during podcast commercials, or really anytime, even cold calling. So many companies were reaching out about the employee retention credit that a lot of taxpayers were taking advantage of this thing and they didn't qualify. So again, what the IRS did on September 14th is say there was an immediate moratorium on the processing of new claims. Those that were in the system, theoretically, would continue to be processed and refunds would be paid. Those that were received on September 14th or later would be basically put in a warehouse for a period of time and not processed. And it was indicated that processing would begin not before the end of 2023, which is why we write at least until 2024. I think everyone's expecting it to be January when processing begins, due to the fact that the statute on 2020 closes April 15th of next year. So interesting timing. And I've even heard rumors about the IRS commissioner talking about a preference to maybe end the program early. That would require some act of Congress, I believe, but maybe Deb, if you have any thoughts there.
Most definitely. And I heard it mentioned for the first time last week that, as if Congress needs revenue raisers, they could retroactively end the program. I would be amazed if that happened. And other panelists on the webinar I was listening to said the same thing. And the person who mentioned it said, well, there was a time when we had credits for oil and they retroactively changed that. That was years ago. It affected a lot fewer people. I don't think they're at all comparable. So I wouldn't expect that to happen at all.
I wouldn't either. I certainly hope not for those that legitimately qualify.
Right.
But keep your eyes out. The other thing as well, like we're talking a lot about withdrawing claims and the moratorium. I still say if you haven't analyzed this employee retention credit and you legitimately qualify for it, you should definitely look at it. So again, there are still a number of companies who do qualify for this that need help understanding the rules, which I think we do very well, especially in retrospect, looking at all the changes that have happened. So there's a lot to keep in mind as you make that assessment, both from an actual qualification perspective and a risk perspective. Reach out to your accountant or to Jerry Bekaert. We're more than happy to have that discussion with you. Again, why the
I think what we're going to see as the new year comes along and IRS starts processing the claims that have been filed over the past couple months, we're going to see more questions coming back to the taxpayer before the claims are actually paid. And I think that only because it makes sense, not because anybody has told me that's what's being discussed, but it makes sense to me that these would be in the form of sort of soft letters. We got your ERC claim. Please tell us how you qualify. And you'll need to respond to that letter, and then they will process the claim. And please tell us how you qualify. You know, you need to send in these government mandates and these effects on our business. And the effect was a partial suspension of more than a nominal part of the business. Or if it's gross receipts, you'll send in, these are all our gross receipts. And, you know, we can subtract and divide, and it's a 20% decline.
And that's one of the things that was pointed out in that Ways and Means Committee hearing as well, is that the IRS really should have had on the Form 941X, since they did revise it actually back in 2020, whether you qualified under gross receipts or government orders. That would have certainly given them the ability to route it one of two ways. Instead, you just see a company applying for the employee retention credit on the Form 941X, and there's no indication as to why. So that's additional work for the service to track that down. And they've also been just paying the money and then coming back and later asking questions, for the most part, at least early on. And so I think you're right. I think you'll see more delays in terms of the timing of refunds due to these, something like a soft letter where they ask some questions. I think it's a good point, Deb. Thank you.
One of the problems is that if you think back about 2020 and the pandemic, which we didn't even call it a pandemic in the beginning, we had no idea how much it was going to affect this country. I was talking with a friend this weekend who worked at Treasury during that time period, and he said they were saying they expected 10 to 20% of Americans to die of this. So there was a real feeling that you had to get these dollars out to the public so that we didn't have a recession. Yeah. And you know, we'd deal with the fallout later, but for right now, we had to keep the economy running while we shut the economy down, sort of.
And I have to say, people express frustration with not getting their money on time, but the IRS did a pretty good job ultimately dealing with all this on paper filings coming in, people not be able to go to the office, still going to the office and get these things processed. I think they did a wonderful job getting money out to people. And so it's just continuing. It's sort of a natural, it's not unexpected that there would be a delay.
Right.
All right. Yeah, some of the things the IRS has pointed out as warning signs. If you're working with an ERC mill, how do you define that? Something like that. There's so much fraud in the system. They're leery of what they're also doing is giving taxpayers the ability and time to check with their more trusted accountants as opposed to potentially a consultant with whom they work. They want to say, like, keep an eye out if you worked with somebody who basically was charging a contingent fee. I might be getting ahead of myself a little bit, but they put some warning signs out there of aggressive promotion that can mislead people to making improper ERC claims. And one of the indicators was if they're working under a contingent fee arrangement, if they say that, you know, you can qualify for the ERC, we can determine that in like 5 minutes. They gave out an ERC checklist tool. I think they revised their FAQs. And again, here it says they're working on a settlement initiative, as Deb mentioned. And that's something that we should see at some point and probably before the end of the year. Do you think, Deb?
Yes.
Yeah.
They've said it'll be out this fall, which,
yeah.
And, you know, we do have people that, in one case, a controller looked and decided that the controlled group was improperly determined. And when they properly determined it, one of the members of the control group fell out and wasn't entitled to the credit. And so, you know, you file an amended return, and it's really not a big deal in my mind. You're not admitting you did anything wrong. You're just saying there was an error made and we're not entitled to this money.
All right, good. So now we're moving on to polling question 2. Do you think you may be eligible to claim the ERC but have not filed for it yet? Not too different of a question than we asked before. So anyway, yes, no, and I don't know. Very good. All right, we'll leave a few minutes for people, a minute for those to respond to this polling question. And again, I'm always curious to see some of the answers here. By this time, I would have always suspected that people might have known, but people didn't have time. They were busy with PPP. They were busy with their businesses, what have you. And then the knowledge of this program became so ubiquitous, like basically everybody was talking about it all the time, that then they wanted to make the determination. So we'll see how this comes up with an answer here. All right. Cool. I don't know. It's 36%. So again, maybe it's unlikely. Maybe it's likely you didn't look into it yet. So one thing is, if you're a business that has fewer than 500 employees, at least as measured back in 2019, that's kind of the sweet spot for some of the benefits, because you can get more of a credit than you could if you had more than that. So definitely seek out either Cherry Bekaert or one of your trusted advisors on this. All right. IRS exams. Hey, Deb, maybe a little bit of just background here. We're kind of covering the same stuff, but it's almost like every time we get to a new point, it's like a little bit back point in time. How have you seen IRS exams go in terms of timing, and then also in terms of maybe some of the expertise around some of the people that are involved in this stuff? What's your experience been? Because I know we've had not too many, actually. There haven't been that many exams in terms of what we've done. We've worked with like over 1,000 clients on this. There have been a few, but curious if you want to talk about some of your experience there.
Well, and sometimes people have come to us to help them with the exam that when we didn't prepare the filing. But generally, yes, the agents are learning about the ERC, and they're behind sort of the public or the people that work in ERC, because, we were working with it in 2020 when it wasn't such an expansive credit. And then 2021, the floodgates opened by allowing people with PPP loans to qualify, and by increasing the number of businesses that qualified for all their wages up to 500 from 100, and increasing the amount of credit and the wages that could qualify for the credit. So IRS really started focusing on this in 2021 when the attorneys were drafting the frequently asked questions and then rolling that out to the agents. But the agents still weren't aware of sort of the onslaught, and which is why in 2023 we see the moratorium come. And I guess the biggest thing I would say, and it goes for all IRS exams, and the people have a tendency to sometimes think, well, if I don't give him everything he wants, maybe he'll go, the IRS, everything they want, maybe they'll go away. If I give it to them in a confusing form, maybe they'll throw up their hands and just allow it. But the real trick is to give them exactly what they ask for, no more, no less, and simple to understand. So I do spend time with our staff organizing the deliverables when we have an IDR request. In one case, I was working with a client who factored all their receivables. So I had to teach the IRS agent how factoring worked and how the gross receipts could be read off of a factoring report. And it's, you just have to kind of work with the person trying to do their job and get it done, which is, as I say, years ago in my career, we were working with an IRS agent and there was another person from my firm in there, and I'm going, but it's not right. He's wrong. And my partner said to me, it doesn't matter whether he's right or wrong. We're here to pay the least money to the government and get out of here as quickly as we can. So we're going to concede and not argue with him anymore. He already told you he doesn't agree with you. We're done.
Yeah, I've always found both in this and some of the R&D audits I've been in, best to be as helpful as possible to these agents to make their job as easy as possible, because there's a lot of other people out there. There's a lot of really bad claims out there. And so I want to make sure that like we differentiate that. We say our deliverables are audit ready, and they are in the sense that they have all the information in there. But when the IRS has a question, I try to, and you as well, we try to give it back to them exactly in the order they asked, so that they don't have to go looking through a file. It's just given to them to make it easy for them. All right.
We've seen also, now we have seen, as the moratorium came into place, we started sending out roller rules to the agents and the managers. They definitely want third-party documentation. So you can't send them a spreadsheet that says, here's all our employees, here's all the wages, here's how we made the calculations. They want to see, show me the payroll tax reports from the payroll tax person, not on a spreadsheet that you built. And in one case where it was gross receipts, they wanted bank accounts for 3 years where the gross receipts were highlighted in the bank accounts and then tallied. Now, in that case, I had never seen anything as onerous as that. And in that case, we had, I think, 25 different bank accounts, 25 different entities, and people were paying this organization monthly, and there were, all of their customers. So we have 25 entities, and they probably have 100, say 100 customers paying them 12 checks a year. I mean, 1,200 checks across 25 bank accounts, and they want us to highlight everything on the bank statements. In that case, we went back and we said, look, this is just, it's just too much. Can we sample it? You pick out a couple entities and then we'll do it for those, or, we can come up with something that's more reasonable and all that work. And the agent said, yeah, we'll work on that. The other thing is they want these things turned around. In the past, usually when you get an information document request, the information document request says, give us back to us in 30 days. And if you don't think you can make the 30 days, you call them up and say, gee, I'm sorry, people on vacation, whatever, we can't make the 30-day timeline. And they give you another 30 days. Now the information document request is 10 days. And in one case, I was not able to meet the deadline. So I went back to, in this case, the agent had already signed off. She was ready to approve the credit. She took it to her manager, and her manager said, no, we need third-party documentation for the gross receipts and for the wages. So the gross receipts third-party documentation is the copies of the general ledgers, copies of the balance sheet, copies of the income statements, copies of the tax returns. So in that case, some of this was so detailed that we couldn't make it. And I came back and I asked her for a 30-day extension, hoping she would give me 15. She came back and said, I can give you a 5-day extension, and I can't give you any more extensions after that. So after the 5 days, you're going to get a letter that gives you 30 days before it gets sent to protest. And you can send us in additional information during that 30 days. So hopefully, because my goal is to solve this with the agent that's examining, and their manager. I don't want to have to take it to appeals, because if I'm taking it to appeals, we already know that 2 people in the IRS don't agree. And now we're going to go and appeals, of course, at the Office of Appeals, it's a fresh look, and the fresh look can take into account hazards of litigation. But I would just much rather settle things at the agent's report, and the agents, I think, would also rather do that.
Yeah.
Penalties, I haven't seen any penalties imposed, although we haven't had, I don't think we've had any unsuccessful ones. So there wouldn't be penalties on the stuff that I'm looking at.
Yeah. And a lot of our stories about the delay with some of these exams is more the clients who come to us after they file with someone else where we're trying to help them out at the end. So all that information wasn't necessarily readily available. All right, let's see what we got next here. Best practices. what to include, proper documentation. Again, when you're filing, again, I think Deb just gave some great insight in terms of what you're going to have in the background as you prepare and think about filing for the employee retention credit. What to include, you're not really including anything with the filing itself. But again, for the examination perspective, Deb, I think, just went through all this stuff, like about what may be necessary. As a baseline, though, when you're talking about, the gross receipts is one thing that she was focused on, the books and records, or the bank accounts or whatever, to show that there was some kind of third-party verification that the company had a decline in its gross receipts. On the other side of it is the government order or government mandate test. That's subjective, might be the wrong word, because technically speaking, you have to prove you had a partial shutdown, but you need to have your facts well developed, indicating what that government order is and how it affected your business and why that created a partial shutdown. And then potentially to show shutting down which portion of the business inside, and making sure that's shown to be more than nominal in some way that can be measured. So that's where we're focused. It's mathematical. It's relying on books and records. It's also telling the story in a way that accurately reflects what happened to the business, but actually being able to show it with some of the detailed records inside the company.
One of the things on the documentation is, of course, if you claim the ERC, you can't also take a deduction for the amount of the ERC. So in this case, you're going to have to go back and amend, unless you're a partnership that's not within the centralized audit system. But if you are a corporation or an individual and you're claiming the ERC, you need to go back and amend your income tax returns for that ERC, for the ERC amount. There are a lot of people now that are complaining that they're going to have to amend a 2020 income tax return and and they won't have their ERC money. So in order to, what you'll have to do, we've been talking to the IRS about this, just isn't fair. You've got to give an extension for amending the income tax returns. And the agents do ask about amending the income tax returns, and they can see whether you've amended it pretty quickly, because the statute's going to run on 2020. But if assuming the IRS doesn't grant an extension, which their position is they don't have the authority to do that. I'm not so sure they couldn't find the authority if they kept thinking about it. But what you're going to have to do is amend your income tax return. You're going to have to pay those taxes. And then, because the statute of limitations on correcting that, if in fact the IRS does not pay your claim for whatever reason, then you need to file a protective refund claim. So what the protective refund claim does, you've already paid your taxes. Now you're going to file a refund claim for those taxes, but we call it protective because you're not quite ready to file it. You mail it to the IRS, you write across the top, protective claim. And when it comes to the amount of the refund, I would put $1 or such other amount as to be determined. And then you have an unlimited time period to go back and what they call perfect the claim. Change that $1 or such other amount to be determined to be whatever number it was that the IRS disallowed your ERC for. That way, you won't get whipsawed with the income tax, amending your income tax return, paying those income taxes, and later having the ERC claim disallowed.
That is like one of the most valuable things that I've heard anybody say on a podcast like this, or sorry, a webinar like this in a while, because it is like worst case scenario that you reduce your deductions on an amended return from an income tax perspective, pay that tax, then you didn't get your ERC, you wait, you don't have the money, and then you can't go back and re-amend to basically do another amendment for that refund of income tax. So it's a rare thing that you have an interplay between two tax systems, payroll tax and income tax, that created this kind of difference in statutes of limitation in terms of when you can do it. But yes, it definitely requires someone to help you out when you're thinking about ERC and how you deal with the IRS and how you also protect yourself. So awesome comment there, Deb. All right. Penalties and interest, we talked a bit about this. proposals withdrawing ERC mills. I think we talked a bit about this. One thing the IRS again said, like, what is an ERC mill? I think you kind of know it when you see it. It's somebody who's really pushing you to claim an ERC as opposed to just being there to the extent you want to. Really pushing some kind of contingent fee, indicating that something as general as OSHA or CDC guidelines that predated COVID are enough of a government order to get you to qualify for the employee retention credit. I think those are probably top three things that I would say if you're working with anybody and that's the fact pattern in terms of how they're qualifying you or what their approach is, beware, I would say, or consult, get a second opinion. Okay, so from an IDR perspective, this has been a wonderful conversation because we've gotten ahead of ourselves a little bit in a conversational way. But things we've seen the IRS ask for: original documentation, right? They're going to want the originally filed 941. They're going to want your original payroll journals. Sometimes if there was a sick paid and family leave credit claimed as well, they're going to want to understand that. Everything around, like, if you're getting a credit for payments to employees not working, you're going to need some reasonable justification to understand, so they can understand how they were paid not to work and who those employees are. The 20 and 21 forms W-2. By the way, this is all sort of standard stuff that we pulled together in like top 20 questions we've seen IRS ask around this stuff. Again, I've mentioned
number 16 is the biggest one and will often take you the longest to compile, because now they're asking for, and they always ask for copies of the government mandate. So if you have a reliance on a government mandate, you need to make a copy of that before it goes off the internet and you aren't able to find it. They want the mandate itself, not just a description of what the mandate says. And then, of course, the significant decline in gross receipts. That was my example with bank accounts and balance sheets and income statements and general ledgers, and tying everything together so that they're comfortable. And I think that is, I had a client tell me, agent tell me early on, usually I just compare to the gross receipts that are reported on the income tax return on an annual basis, and I get a feel as to whether the quarterly receipts are correct or not. But now they're not taking that I can get a feel. They're asking for the taxpayer to not only show them the gross receipts number they used, but also to show them where they got that number and prove that it's in their financial statements or in their general ledgers and things like that.
I think some of the abuse that we've seen in the system, you and I personally, is for these large employers that had like 1,000 employees or 500, anything more than 500 full timers back in 2019, or more than 100 in 2019 for purposes of the 2020 credit. We've seen some providers take the position that paid time off, basically vacation time, is treated as time, what they call non-service wages for payments not to provide services. It's specifically indicated in the IRS guidance that in the notice that PTO payments are not to be treated as payments for time not worked. And then I've seen some of the ERC mills say, well, but the IRS guidance isn't controlling in this case. Okay.
Or isn't right.
Or isn't right or controlling. And then but then they'll say, but we found a supply chain disruption. And then I'll say, but that's found only in the IRS guidance. It's not in the law. Well, in that case, we like it. So it's very much pick and choose what they want. And so I think we've had an interesting time on some discussions over the last 2 to 3 years with some of the ERC mills. And basically sometimes I'll be asked to review something and I know exactly what the deliverable will say before I even look at it, because it will be a carbon copy of what some of the other things I've not to use a term that no one uses anymore, carbon copies, but it'll just be something that like they're basically cutting and pasting for many of their clients, unfortunately. So,
well, and I think the using PTO is something that the IRS is clearly focused on.
Yeah.
I have a number of friends who are lawyers and have told me about some of the huge claims that they're arguing with at appeals. And in one case, the attorney said, well, we would have maybe given them about 10 or 15% worth of what they claimed. And that was exactly about the number that I came up with for one of our clients, one of our audit clients, that we had to disagree with the ERC claim. I hope it does go to court, and so we can see what'll happen. But
And your theory on that one, if I recall, was you looked at the amount of COVID sick leave wages where they were too big to get an FFCRA credit, but that was technically maybe time not work that they were paying for the people to be out on a COVID sick leave as opposed to normal PTO. So that had some legitimacy and made some sense to me. And we've talked about that position with others, but yeah, you've seen these ERC mills just put like tens of millions into the claims when you have these large organizations where they're paying people PTO. And in 2021, they'll claim all 3/4 of 21 based on a fairly flimsy analysis of whether or not they qualify. So we'll leave
And
it.
I don't think they're able to get any legal opinions that it works, but
no, they have a lot of legal opinions. They seem to, but they're all written to each other or their internal memos, as far as we've
they're
seen.
internal memos.
Yeah.
I haven't seen any of the outside big law firms agree.
Perfect. All right, enough railing on the ERC mills. Here we go. We're continuing that discussion now a little bit. Again, these are the warning signs. I went through these already. Keep an eye out for those that are doing the contingent fees. Rely on CDC and OSHA guidance that are trying to throw PTO in there as time not worked. Also, if your revenue skyrocketed in 2021 compared to 2019 or 2020 compared to 2019, you're going to have a tough time just passing the smell test with the IRS. Whether you do qualify or not, you're going to have to, you'll have a fight there, in my opinion. So you're going to need to prepare at the very least. Dirty dozen. We keep going back in time, but I think the whole point here is this happened in May. In September, the IRS came out with a moratorium, but again, the IRS annually lists it's like 12 top, we'll call them tax scams, things to look out for as a taxpayer. Number one this year was the employee retention credit. And again, I'm not saying that the employee retention credit is in any way a bad program or in any way not something that is deserved by those companies that actually qualify for it. The whole point here is just we've seen so many ERC mills put in or talk clients into qualifying that it's often been a difficult conversation at times with clients because they've been hearing such disparate information from us or other reputable CPA firms compared to what a promoter, for lack of a better term, or ERC mill may be telling them. But I've talked about all these things already. And again, there's a moratorium, there's a potential procedures being put in place for those that have received money and paid fees to some of the mills. We shall see what happens in the next month. And I'm sure as we do one more of these next month, there'll probably be a development such that we can report on it to you in December. Still another way of saying, though, look at it quickly, though, if you haven't looked at ERC eligibility, because it is going away for 2020. All right, polling question 3. Fourth comes not too far after this, but which there may be a warning sign. Fees based on a percentage of the credit claim, reliance on the employee to determine if they're qualified for the ERC, meaning you're looking for the employer just to sign something and give it back to the mill so that they can then use that as their justification, basically shifting liability to the taxpayer. A 2-minute online app process, just OSHA guidance as a government mandate, or any of the above. This one's not too hard, but we'll see what the answer comes back with. And please make sure to fill this out so that you can get your CPE. And we'll let you answer for a moment and then finish up. I have a number of slides to get through, but we're going to get through them quite quickly over the next 9 minutes or so, because I think we've covered most of what we really want to talk about. But yeah, any of the above, they're all right answers. So we're all winners on this one, or all losers if we potentially didn't look at this stuff. But thank you. All right. OPR. I've just seen some writing out there. Do you want to talk about this, Deb?
Yeah, so
Yeah.
I've seen people that say they're concerned about amending an income tax return when a credit was claimed and it should not have been claimed. And they are concerned that adjusting the wages on the income tax return and signing that income tax return as preparer somehow associates them with the ERC claim. And that's just wrong. I mean, the person that's associated with the ERC claim is the person that signed the employment tax return that claimed the credit. That's the person that has the liability, and in fact, or prepare a liability. And in fact, if the income tax return, once that claim is filed, fraudulent or mistaken or whatever,
then the income tax return needs to be adjusted. And I would say if you don't adjust it, even when you think the claim is wrong and shouldn't have been taken, you need to decrease the wages, which will increase the income. Clients hate that, but it's what the rules are. And therefore, you should be doing that as a preparer of the income tax return. And to not do it because you think the claim is wrong makes you file an erroneous income tax return. I think the IRS guidance could have been more clear on when they were talking about the preparer for the employment tax return versus the preparer for the income tax return. The income tax return preparer is not going to be liable for the ERC that's bad, but they do need to make sure that they adjust the wages, even if they think the claim is bad.
Yeah, it's confusing because when this came out in March, the general discussion point was to the extent a income tax preparer knows, shall we say, that an ERC claim is invalid, and yet they follow it and reduce the wages by the amount of that ERC, they're somehow perpetuating the fraud. And so that's what's been discussed, and that's maybe the way this thing can be read. But I have a tough time seeing the IRS coming after an income tax preparer for purposes of when they're taking a position that gives the IRS more money. It just doesn't seem like they're going to like push on it too hard. But regardless, I'll just say this to any preparer out there: advise your client if their ERC claim looks bad and have them take a second look at it. And maybe before you do that adjustment, take a look at some of these withdrawal programs as well.
Yes, true. And then you don't have to do the adjustment.
Yeah, exactly. Ways and Means Committee, I talked about this. What they talked a lot, it was again, two practitioners, somebody from a PEO. And again, we've found a lot of frustration with taxpayers and their PEOs because this is the first time using a PEO seems somewhat inconvenient because they're waiting for this information, this money from the employee retention credit, and the PEO has to do the filing, not the taxpayer itself. And as a result, they have no recourse to work with anybody other than the PEO. The PEO works for the government, but the PEO claims where they do them in batches with all their different clients together, they're on serious delays because the IRS is figuring out the best way to look at all of them at once. Now, some of those initial ones in 2020 got released pretty quickly, some in 21 as well, but it does seem like I have gotten more calls from non-clients asking if there was anything that we could do to interface with the IRS because they've been working with the PEO, and the answer is no, not really. They have a contractual arrangement with their PEO. The PEO is a representative for payroll tax purposes. And so there's nothing that we could do or that they can do other than work with their PEO. Consequences of receiving an overpayment. Basically, it's treated as a, maybe Debbie, you want to talk about this for a second too. This came out in the regs earlier this year.
So because this was an off-code provision, it was in the CARES Act when it was first enacted, then IRS didn't have a lot of the protections to enforce the rules. And so that's where you're seeing some proposed final regulations that make it clear that the ERC is going to be treated as a tax liability. So that gives taxpayers protections, and it also gives the IRS abilities to use different ways to assess the taxes.
Yeah. Overpayment of ERC to taxpayers treated as an underpayment of tax by the taxpayer. So
right.
Interesting.
Right.
All right. Issues with acquisitions and dispositions. The whole point of this thing. Why don't we talk for a little bit, Deb, here, just about some of the stuff that you've seen, maybe some of the hot button issues that have come through.
Well, I guess in the private equity considerations, most private equity firms have a fund with portfolio companies underneath them. And because of the way the controlled group rules work, and it's very clear to everybody, including the IRS, including Congress, that those portfolio companies are not part of the same controlled group, even though they're all owned by one fund. That's because the fund is not a trader business. Just as an aside, in the most recent tax law, the administration tried to get that rule changed, and there were Congressmen, Kirsten Sinema from Arizona, who held it all up. I heard on the national news some controlled group rule. Sure enough, they got it out so that it's really clear that the private equity portfolio companies stand by themselves, and that's important for gross receipts testing, for the number of employees you have.
stock acquisition, dispositions, asset acquisition, and dispositions. So typically when you buy the stock, unless you or when you buy the stock, unless you pull out something in the purchase and sale agreement that either leaves the liabilities behind or it speaks to tax liabilities, then you're going to have the ERC is going to follow the stock. Just a change in shareholders isn't going to change the people that are entitled to the ERC. The company is still going to be entitled to it. That's different when you have an asset acquisition. The ERC claim usually stays back with the seller in an asset transaction. And delayed refunds, I guess the biggest part in delayed refunds that I see is not delayed refunds for ERC, but the payments. So people could defer their Social Security taxes in 2020, and those taxes had to be repaid in 21 and 22. And we've seen situations where in those amounts were not repaid and the transaction was and the business was sold, and that meant the acquirer took on that liability. So it's deferred Social Security taxes as opposed to ERC. And that's about all I have, I think, on.
Very good. So we'll go to polling question 4. Would you like to learn more about and help moving forward? Yes, no, maybe in the future. All right. So, well, to give you guys a minute to answer this, I just want to personally thank Deb Walker for basically like a few days ago. I just asked her if she had the ability to join me here on this podcast. Deb's always made me a better professional every day. I've learned a ton from her while I've been working on this, and she's got a wonderful approach. And I think her advice today has been excellent. Certainly an asset to our firm and to those organizations with whom she has worked in the past, but we're lucky to have her. So she's been excellent doing here. And I think some of the insights she's had and the relationships she's had have colored some of the discussion she's been able to provide today to everybody on this. It's really good to have somebody who's got those connections deep within both the government and along the professional networks here. So this is my little thank you to Deb for joining us today. And my thank you to everybody out there. We're going to go yes, no, maybe in the future, see how this comes up. But like the last slide, because we only got about a minute left, is like the benefit of working with a full service professional accounting firm as opposed to a consultancy. We don't show the results here, but generally speaking, it is, we can take a more holistic look at what is going on beyond ERC, right? We can look at other things like R&D credits. We can give a fee structure that is much more favorable to the client, free scopings, looking for additional benefits as well. Generally speaking, when you're working with just a consultant, the fees are higher and the payments are, a little more upfront at times, but also the thoughtfulness around the overall return isn't there. And maybe the thoughtfulness as well around the IRS defense is not there either. So R&D credits, a lot of the Inflation Reduction Act stuff we're working with clients taking a look at, and you'll see some overlap there in the companies that can claim both. Cost savings studies, overall state credits, incentives, and new markets tax credits as well for companies that are expanding into low-income communities. I just want to thank everybody for joining today. There's a lot we can offer. I hope this was good for everybody who was able to join. We thank you so much for tuning in. Tune in a month. We're going to do it again with some more updates and take a little different spin on it with a different topic. Everybody, thanks so much for joining and have a good one. Take care.